Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now. Shares of Carvana are down about 93% over the past year, and they're down a brutal 97% from the all-time high. Here's the thing. The company is still growing its revenue generally, did about $13 billion in sales last year. And there's a lot of investors out there looking at that stock thinking this is the time to buy. But let me tell you, things could get a whole lot worse for shareholders before they get better. I'm Jason Hall. This is The Smattering. I've got Tyler Crow here with me to talk about it.
Jason, you and I know a thing or two about companies down 95% that could get worse. So
yes,
this is not our first rodeo.
What rhymes with offshore drillers?
Bankruptcy.
There you go. There you go. So I think I want to be careful tossing the word bankruptcy out there for Carvana.
Sorry. That was a foregone time.
No, it's good, but that's important because I don't think that's necessarily what we're thinking about with Carvana. But we're not at that point yet. But let's unpack everything that's happened with Carvana. If we go back to 2017, the company went public, $15 a share. Within a few years, the share price was already over $100 a share. It's about $8 a share now, so we're roughly half the IPO at this point. Even though revenue has continued to grow, what's going on?
One of the things that we are finding is that it's a little harder to sell used cars than I think a lot of people gave Carvana credit for. The concept of Carvana sounds nice on the surface. The idea of shop online, guaranteed price. You're not spending time haggling at a used car dealership.
And then they have their giant, I think of them as car Pez dispensers, basically.
Yeah, the gum drop the fancy quarter and the thing comes rolling down, which, yeah, I don't know, pretty gimmicky, right? Basically, they were like, we just want to improve the customer service experience with used car buying.
Yeah, not the most pleasant of experiences.
Sounds nice, but when you start to get into the mechanics of selling used cars, that's where it gets hard. Number one, as much as we do it online, you still need actual places to house and inventory all of your vehicles that you're purchasing either at auction or trade-in centers.
To get them ready for sale. I think the reality is that we have not, Carvana has certainly not benefited from economies of scale to this point.
There was a little bit of a halo effect in the sense of Carvana, this idea of if we apply Silicon Valley tech to develop pricing algorithms, we can beat used car people, right? Used car people aren't idiots. They've been doing this for decades. They have decades of pricing data that they build into their systems too. And that matters. Carvana, they weren't making the average profits.
The result of exactly that, we've seen the business, even as it's continued to grow, has continued to burn cash. If you go back to its IPO, it's never generated positive operating cash flow. And this is really important because sure, there's good reasons that maybe a company at this stage of its business might not be profitable on a GAAP basis, but it's another thing to not even generate positive cash flow from its operations. And as we see, as revenue growth accelerated, the operating cash flow burn also accelerated.
There's some mechanics to that because, if I'm getting bigger, I need to have more cars, which means I need to purchase more inventory, and inventory comes out of operations.
It's a cost of goods sold.
Machines.
So it's right.
So there's that component of it, but eventually.
But that should be canceled out by the gross margin that you're generating off of selling those cars. And the key, again, in theory, but we haven't. And we don't really necessarily have to hash all of that out. I think the key is, okay, how do you cover that delta? And to a certain extent, you can do it with cash on the books, right? It went public and it raised some cash. Didn't raise a lot of cash, though, out of its IPO, but it has steadily had to issue more and more debt. Now it's up to over $8.3 billion in debt and $434 million in cash based on its most recent quarterly operating cash flow burn. That's 4 months worth of cash, Tyler, which brings us to a head. What's the company doing right now to try to address it?
There was a recent announcement from Carvana. Basically, they're going to do a big bond swap because a lot of its debts are trading very low, and they think that they can buy back some bonds that are trading at less than par, which means basically they're discounted to basically market saying, we don't think that you're going to be able to pay these back. So we're going to swap them out.
There's the distressed business part of it, burning a lot more cash than you actually have on the books to cover your expenses. So that's the distressed business part that is going to cause those bonds to be discounted. But there's also the interest rate reality. Most of that debt that it took on in very easy money times.
Even at easy money, it was 5.6%. So it's not like it was cheap debt either. For them, that was cheap debt. Like for a business like that's cheap debt. But even
because you'd be looking at
that
similar
level,
debt would be high 8s, 9%, maybe higher.
Well, that's exactly what they're trying to do today.
You're going to talk about it. What it's actually doing, trying to swap the debt out, swap that debt. What are the rates?
So what they want to do is they want to buy back debt to lower their annual interest rates, right? Because look, if we can buy back a bunch of debt for less than par and we issue this new debt, we think we can bring down some interest expense, lower that cash burn. But it is a desperate issuance. They want to issue notes that pay 9% cash, or if we can't pay in cash, we will give you 12% in kind. In kind payments basically means if we can't pay cash, you get 12% accrued on top for the next payment. They're not convertible. They are secured against vehicles, against every asset that they own. So it's not even converted to equity. It is just payment in kind. If we can't pay it,
that adds another level of, I want to be careful about using the word desperation. I want to be careful about using that word, but I think it largely fits because they're steadily being accrued more and more assets from the business, right?
Exactly.
Yeah.
I'm going to give them to be fair.
It's a glimmer of hope here. What's our glimmer of hope?
Slight glimmer of hope. I have seen companies pay PIK loans before and recover. It's not the absolute end of the world. I can actually name a company right now. It's called Calumet Specialty Product Partners. They're a refiner that makes like specialty lubricants. They did it. It was the best CEO management job I've ever seen, pulling a company from near insolvency to something that resembles a business. So it can happen, but it doesn't happen that often. And I don't know if Carvana, with what they have, is going to be able to do something like that.
Last words on this. This is the way I think investors should be thinking about Carvana right now. It's easy to look at a company that grew its sales so quickly. It's popular. It seems like maybe they have addressed some of these issues, but at the same time, they're quickly running out of time to actually generate positive cash flow, to become a sustainable business that can live within the proceeds of its own operations. And it's making almost a last-ditch move here that's moving some of its debt holders a little further up the ladder to be able to recoup losses in a worst-case scenario. That doesn't necessarily mean that there's not a path forward for Carvana investors. It just means that if you're going into this, you need to understand that this is an extreme turnaround play on that slim chance that they're able to turn things around, or stay away. You get to make the decision about what makes sense for you with that.